Hi, I'm Grace, and you're listening to Bread and Honey, the money podcast where we chat to influential and inspiring people in the financial space about everything and anything related to your personal finances. Brought to you by our friends at Marble. Today, and for every episode, I'll be joined by Patricia, who is an author, credit expert, and financial guru, to ask all those important questions to our guests on the show. So for today's episode, we're joined by Richard Moxley. So after 7 years working as a mortgage broker, Richard finally had enough of watching the average Joe forced to pay thousands more in excess rates and fees, all because no one had taught them about the rules of credit. So from here, this led Richard to write the 9 Rules of Credit and also the Credit Game as well. So Richard is more than qualified for today's episode to discuss with us what is a credit score. So we'll be discussing everything from what's a credit report, ways to improve your credit, every tip and trick you need to further boost your score. So let's tune in, and I hope you enjoy episode 3 of Bread and Honey. I just want to welcome you to Bread and Honey. So for today's episode, we're going to be discussing credit scores. So we recently feel how the world is going. We're in a pandemic. We feel a little bit insecure about our money, our jobs, and of course our credit score. And a lot of people are talking about credit scores. They can be confusing, but we want to give you all the answers. So for today, I'm joined by Patricia, who is our resident financial guru and credit expert. And also I'd like to give a huge welcome to Richard Moxley. So Richard, we're very excited to have you here today on the show.
Well, thank you.
Yeah, no problem. And Patricia, welcome as well, as always.
Thank you, Grace. I'm actually super excited to be here with Richard, and I'm really looking forward to this conversation.
Yeah, I'm super excited myself because Richard, you're a best-selling author, you're a credit expert, and for anyone who may not know, Richard, can you tell us a little bit about yourself and your background?
Well, my background in the finance industry started with mortgage financing back in 2006, and did that for quite a number of years. And then in about 2012, I published my first book, The 9 Rules of Credit. And ever since the book came out, people said, well, the book's great, but can you just fix it for me? And so that kind of led me to focus more or full-time on disputing errors and fraud from credit reports and leaving the mortgage side behind and focus just on teaching Canadians how the scoring system works and, of course, working on their behalf with Equifax and TransUnion.
So tell us about why you got into helping Canadians improve those credit scores. So I know it was your mortgage background, but when did you decide one day that you were going to change your career completely and just focus on credit scores? Was there a turning point moment for you?
So the biggest, I guess, problem, or the reason why I wanted to write the book in the first place, and Patricia would appreciate this and probably has a similar reason, is that with a mortgage broker, you only get paid when you complete a file. And so when I first started, you have to basically eat what you kill, if you want to be graphic on that, but it's all commission. And so in order to get deals done, I had to make sure that the client not only had, the income and the down payment, but also the credit. And so I kept on running into people that had everything else, but the credit was not there, or they had just finished some kind of debt program. And it broke my heart to have to tell them that if they had just done a couple things different a couple of years ago, then they'd be looking at best rates and best terms. But now either they were declined or they're going to be charged higher rates and fees. And when looking at the credit report, as a mortgage broker, you do take a course, but they don't really teach you how to read a credit report. So everything is trial and error and trying to figure it all out. And after spending years talking to underwriters and banks and trying to get deals done and desperately, very desperately trying to get deals completed, then it became something where, talking to people, whether they were new to Canada or doctors or well established, whoever it was, other than paying your bills on time, there wasn't a lot of common sense or common knowledge out there. And that was something where, being very busy on the mortgage side, I didn't always have time to educate or spend that time with consumers. And that was something where, the book was supposed to fill that need. But after spending 3 years studying thousands of credit reports and trying to figure out how the scoring system worked and working through all the myths that are out there, it really became a passion of mine. And when people started asking, can you just fix it for me? I'll pay you, but just can you deal with Equifax and TransUnion? That was kind of a light bulb for me where, okay, so there is a demand out there. There's lots of great mortgage brokers out there, but is there really a resource for Canadians that have questions about credit or have errors and need that help? And so that's where I thought, you know what, that's more of a passion and it's a definite need out there. So that was kind of the moment, if you want to break it down to that.
Okay, so I suppose your book, The Credit Game, came before then. You venture into the world of credit scores, and then the 9 rules of credit. Then, what stage did that come in? Was that just kind of a follow up, or what was kind of your premise behind writing that book?
Actually, it was reversed. So the 9 rules of credit was first, and then the credit game. What I noticed is that people, after spending, working full time with credit, is that people were nervous, overwhelmed, and very confused about how the scoring system worked. And a lot of the rules of credit weren't common sense. And so I wanted to do an updated book, one, because there was a number of rules that have changed with both Equifax and TransUnion on the scoring system. But also I had learned a lot more, having dealt with, even thousands of more people with the score or looking at reports and studying those. And so the credit game is the most up to date, and it also has a little different, more of a feel that I wanted to get across to the consumers or to Canadians in general, instead of focusing just on the score, but learning how the scoring system works, or what I call the rules of the credit game. If you know what the rules are and you know how to play the credit game, then it puts you into control, as opposed to just kind of, the deer in the headlights type of thing. And so I see it as a game. I see it as something that can be fun, but definitely interesting. And, there's strategies involved. There's different plays that you can do. And yes, there's some penalties as well. But if you know how to play the game properly, then taking a penalty here or there really isn't that big of a deal. You just get back in the game and change how you're doing it.
No, that makes sense, because, credit scores, they can really be a mystery, I suppose. And one of the reasons why we want to have you on the show today is to try to provide our listeners with the ins and outs of the score alongside Patricia. We recently conducted a sentiment survey among our Marble customers, and we discovered that 60% of respondents were actually afraid to check their credit score. So I feel that's a pretty high number. I really don't think that someone should be scared of their score. So why do you feel that, maybe Canadians are in fear of their credit?
Mostly because they don't know what that means or how to interpret it. If I were to take you and put you into a country or a situation that's not familiar, so a different language, a different, situation, living circumstance that's completely foreign to you, I think you get a little bit of a sense of what a lot of the consumers out there are seeing with the credit. It's not something that's easily interpreted. Yes, there's a score. Yes, the higher it is, the better. But how do you get the score up? How does that all work? I pay my bills on time, but why is it still low? Why does it keep on moving up and down? And banks are obsessed with the score, but yet even the bankers don't know how it works or how to advise. And so you get a lot of confusion, I know this is important, but I really don't have the brain power or the desire to learn a different language. And that's something that's intimidating for a lot of people.
No, I completely get that. That's a really interesting point, that it's basically like a different language, credit scores are. And we're just really going to jump back to basics here. So Patricia and yourself, Richard, what is a credit score exactly? So I know that's such a vague question. It's really open-winded, but what exactly is a credit score? We can go to yourself first, Patricia.
Sure. Well, a lot of people get all caught up with a credit score, but really it's the body of the credit report that tells a story. And I think the credit score is designed just to be a snapshot of your credit profile at any given time. And if you use it wisely, you will gain points. If you have trouble managing your debt, then your points or your score starts to tumble. And, like I say, it's a snapshot of where you are at any given point of time. You agree, Richard?
Oh yeah, I like the fact that you mentioned that the actual details on the report is really what controls the score, but that's what is really where you get more of the story. The score is that snapshot. I refer to it as a good first impression. So
Yes.
if you were going for a job and you show up with well-dressed, smile, confident, good resume or whatever, or just it looks nice, then that's a great first impression. But you're still not going to get the job if you have no job experience, no history, nothing to back up that good looks or that smile or that confidence.
No, yeah, that makes perfect sense. Like, how do they work? So I know that they're based on your credit report, and you mentioned the snapshot. So what do you think, Patricia and Richard? How exactly do they work in terms of, why are they useful to us, and why do lenders look at them and pay such close attention to your credit score?
You know what I think, Grace, a lot of people don't understand the credit report, because some clients may have an excellent score, but they have absolutely no credit. So no credit is just as bad as having poor credit. And as far as, when I meet with clients, I want to determine what's in the body of the credit report, if they've missed any payments.
The score, in my opinion, is just a tool that the banks use. And in my opinion, it was much better when they didn't have the score, just because of how much confusion it causes. But the score is something that banks use because they are looking to have a very quick way to analyze risk. And so when you're dealing with millions of applications at a time, and seeing as we're all moving towards, online applications and more technology, it is a lot cheaper for a bank or a lender to then process those applications electronically without having to spend years training a banker. If you go into a bank, you will see that they are younger and younger, and they don't stick around near as long as what they used to. Back in the day, people used to bribe their banker, invite them to Christmas parties. It was something where to have a good relationship with a banker was, one of those very elite things to do. But now pretty much the banker themselves don't look at the credit report or don't understand it at all, and are basically are just waiting for the system to tell them whether it's approved or declined.
To add to that, Richard, back in the olden days, we used to, as a banker, manually calculate the credit score. And if we like you, you're going to have a better score. Or if and so, yes, we do a lot of credit profiling back in those days. And that's why and how we understood in the last 40 years how to build a credit score without even pulling it from Equifax or TransUnion. And now they use modern credit scoring systems. The credit bureaus are able to evaluate millions and millions of consumer applications quickly, and they consistently and ever so changing the scoring system. And credit scores are unique to each individual.
When it comes to a good credit score and a bad credit score, does this really depend on what your financial goals are for, what actually constitutes a good credit score? Or is there just like, point blank, a good credit score and a bad credit score, if that makes sense?
Well, really, a good credit score determines how much money you can borrow based on your income and how much interest you will be paying on that credit facility you're applying for.
Yeah, it depends on what they're going for. Like, for example, Patricia has a history in mortgages as well. So, they have a benchmark of 620 or, now CMHC.
680.
Yeah, CMHC's bumped it to 680. So they have a benchmark, what they use on the score. But then, as Patricia had mentioned previously, even if you have a 680, if you don't have everything else that's needed behind there, you're still going to get declined. So it's just one of those benchmarks that kind of controls the interest rate and the first step of everything. But then there's a lot more that goes into it.
Exactly. And a poor credit means that you're under stress and may not be able to concentrate on probably getting a job or you're in financial difficulties or living beyond your means. Results of it is people are taking time off work. They may be short-tempered at work. Many different reasons. And I think we'll get into that a little bit later.
Yeah, so I suppose with a bad credit score, then can you still obtain financial products? So I know, of course, as you've mentioned with the mortgage background, it's 680 now. For a mortgage, the credit score needs to be. So can you still obtain other financial products? And how would somebody, for example, who might have a credit score, in and around the 500 mark, how would they obtain financial products? Would they need to increase their score?
Yes, they do. But they do have subprime lenders. So it depends on what you're looking for. If you're looking for a mortgage with a low credit score, you'll have to come up with a larger down payment. You'll have to get a first mortgage up to 75% with either a subprime lender or alternate lender, and a private second, which again, the interest rate is very high, anywhere between 12 and 15%, and the cost to borrow, lender's fees, broker fees. And so the lower the rate, the lower your credit score, the much more money you pay for getting credit.
Okay. And Richard, how are credit scores calculated then? So I know we will come on later to exactly scoring models, but what would be the general rule of thumb that most lenders would use?
Well, I just wrap it up to magic. But,
I agree with you.
Yeah, that is a very difficult question because of the fact that there are different scoring systems with different companies, and then each Equifax and TransUnion have different scores that are available, which just makes the whole process a lot more confusing.
Yeah, definitely.
And if you go online, you can see these, credit pie wheels that, FICO, which is one of the scoring systems that originally came out, they created this pie wheel back in the 1980s on how a credit score is basically generated. And they give you some basic guidelines, 5 or 6 categories, depending on what type of, which version you're looking at. But yeah, and some of those are there, but Equifax has almost about 100, and TransUnion as well, different categories that they're looking at, different codes that they're analyzing it on. So if you wanted the simple version, a lot of them are payment history, how long you've had it open, established credit, new credit, that kind of stuff. That's some of the things that they look at. How they categorize that and the percentages, I disagree heavily with what is seen online, but that's gives you a rough idea of some of the things that are important to them.
Well, I think Equifax uses FICO, and TransUnion is using Vantage 3.0. And so FICO, they develop a proprietary algorithm that scores borrowers between 300 to 850. And they score it based on the creditworthiness of the clients and a variety of information contained in the consumer's credit report. For example, detailed credit histories on individuals. And FICO is industry specific based on the type of loan the client is applying for and the individual credit habits for lenders. They just provide numerical credit scores based on individual payment history and the amount of money borrowed. TransUnion, I know they keep up with the behavioral trends and the data. And again, FICO rewards borrowers if they can manage your debt, types of debt, for example, mortgage, loans. But they penalize you if you're shopping around for credit. Credit inquiries really hurt you.
Okay, yeah. So that would be their credit scoring model, I suppose.
Yes.
And okay. So is there only a few credit scoring models, or does each credit bureau, for example, use completely different ones? And one thing that I was kind of always a little bit confused about is that, why can't there be like a universal credit scoring model? Is that something, maybe, I don't know if I'm being a little bit naive, but what do you guys think?
I think it's a great idea.
It would make it so much easier.
It would make it easier, but there's two main companies here in Canada, and then every bank or lender has their own way of interpreting and underwriting that information as well. And so we are lucky because in Canada there's only 6 major banks. There's a few more popping up that are becoming bigger and that kind of thing, but at least in the States, they have 3 main credit reporting agencies, and then they have a ton of different banks and lenders. So we are lucky that we have less than some other countries out there, but it's still confusing because each company, each bank, each lender will interpret those things differently, and unfortunately, I don't think there's a way around that.
Yeah. And what do you think, Patricia?
I think both the scores are likely accurate, but lenders use specialized scores and they calculate differently depending on the type of loan the clients are applying for. Lenders consider other factors besides your credit, especially if you're looking for a mortgage or a loan. So it's not all based on the credit score, but again, we're back to on the body of the credit report.
Okay, and can this negatively impact a consumer then, that a credit score differs depending on where you check it, I suppose?
Between Equifax and TransUnion, if you have a bankruptcy in the past, it stays longer on TransUnion than it does on Equifax. And so it varies about 100 points between the two. But that's probably the only reason I see a huge difference between the two credit reports. For the most part, they're almost similar in the reporting by the credit reporting by the lenders.
Yeah, I find a lot of issues with the collection agencies and smaller lenders. Some will report to Equifax, some will report to TransUnion, some report to both, and then some don't report at all. And that is very confusing for a consumer who is signing up for, let's say, a loan and assuming that it's going to be on both credit reporting agencies, but it may only build or show up on one. And if they're only checking one, or each bank uses, most of them use Equifax, but some do use TransUnion, and some do look at both depending on what type of financing. And that's something where if you're looking at one credit report and seeing everything good to go, but then there's stuff missing on the other one, or as Patricia mentioned, there's stuff reporting on there that's negative, then all of a sudden you see hundreds of points difference between the two, and that's something that you think you're doing okay, but then you're getting declined just because the bank is using the other one that you're not looking at or familiar with.
Okay, so when it does come to credit scores, I feel like there is an age-old question. Obviously, how do we improve our credit score? What practices should we take to help get those extra points? And this is completely understandable. I feel it's a good question for someone to ask. It's good to be curious about how to improve your score. A good credit score can help us in many ways when it comes to the likes of loan approval, credit approval, or even the likes, sometimes landlords or, probably rarely jobs check your credit score. So, for example, if someone was to come to both of you and say, I have a credit score of 500, what are the first steps I need to take to improve my credit score? What sort of advice would you give them?
So the 500, my first conversation with everyone is I would need to see the reports just to know how to help, because the score itself, if people do this to me all the time, they'll call me and they'll tell me a score and they'll say, how do I do better, or how can you help? And I really have no clue until I see both reports. But to give, I guess, a general on bad credit to now good credit, a lot of it has to do with how are you treating your current accounts. And when I say accounts, I'm not talking banking or savings or checkings. I'm talking about like credit cards, lines of credit, loans, mortgages, cell phones. Those are the credit accounts that show up on the credit report. And mostly, are you paying your bills on time? What's the balances on your credit cards? And then look at, okay, so is there something that's holding it back that needs to be either settled or taken care of? Or what additional credit can you get in order to satisfy the type of financing that you're looking for, or to jump up that score?
So I look at it a little bit differently. I actually analyze the credit report. I want to see how many credit cards you have, how old your credit cards are. I also want to know what's the credit utilization on each one of your credit cards, because as we know, a big part of credit utilization on the credit report consists of 35%. And which is 270 points. So we take a look at the balance outstanding. If we can take borrow from one credit card and pay the other to keep it under the 30%. So we just try to balance that out for the clients. We want to take a look at if they have any collections on their credit report, how old the collections are, because sometimes if the collections are close to the date last active of being close to 6 years, you don't want to touch it, or else you'll be reactivating the points again. And so like I said, we analyze the credit report and see what else we can do to help those clients. If it's inquiries, not much you can do. If there are collections, try to settle the debt. If there's a lack of positive credit, give the clients a credit card, get the clients secured credit cards, because with the 500 score, you won't be able to get approved anywhere, and no point shopping to drop your score. And get them secure credit cards, and hopefully we can get them a loan. So you need two secure credit cards on one installment loan to start rebuilding your credit. Rule of thumb.
Okay, so would you then agree that it's good practice to have a credit mix? So, a mixture between like installment credit, revolving credit, when you're searching to improve your credit score?
The more revolving credit you have, the better it is, because you can use the revolving credit to your advantage by using it more than once a month. Especially you look at the statement due date and make a payment before 3 to 4 days before the statement date, and make sure you make your payment before the payment due date, because you wouldn't want it to report as a missed payment. And just those two payments start to increase your score quickly.
Okay, Richard, would you agree then a credit score mix is, it will help, or what do you think?
So yes, but I differ from a lot of people in the industry. I don't suggest going and getting loans unless they're for a specific purpose that are going to be helpful. One of the things that I don't like is getting loans that are high risk or high interest rates just for the sake of building your credit. Yes, you may get a couple of extra points, but to go in and get high interest loans just to get a couple point jump, I'm much more of a fan of the revolving credit, because you can get, if you use the credit cards properly, not only does that affect the score much more from what I have seen, it also is what most lenders are looking for, that you can control the credit cards, the revolving credit, which is a credit card or a line of credit, and then use loans if you need them, or if it there's an advantage there, then great. But focus more on the revolving. I know there's some people out there that will advise someone to get a cell phone and a mortgage and a loan and credit cards, just so that they have a good mix. But yes, there is some benefit there, but I think it all depends on the personal circumstance of the client, just because I'm not a big fan of getting them into high interest rates.
Okay, and just to jump back a little bit, for maybe listeners who may not know, what is revolving credit and what is installment credit?
An installment loan is a loan where you make monthly payments, the same amount of payment every single month, whereas a revolving credit is a credit card or a line of credit. You can use it at any given time. You could pay it off, pay it down, pay it off. It just revolves. It's not a constant payment every month, but they do calculate it at 3% of the balance, Richard, on the lines of credit, and so you have more flexibility in using your credit cards and lines of credit.
Okay, and what are some examples then of both of those? So credit card would be revolving or installment?
Revolving.
Okay, and then just a regular loan then is installment credit.
That's right.
Okay, cool. Yeah, so that's great. So learning all these credit score tips and tricks, I suppose, is not something that we're generally born with. So we have to learn these as we go along. And I bet we all agree that we could have did some things a little bit different when we were younger. So for example, when I was in college, I actually look back now and think I had it pretty easy, because I know compared to in Ireland, for example, it's probably a lot different than here in Canada. We don't really usually come out with as much debt from our university studies. But when I was in college, I worked as a waitress throughout my studies, and I worked a lot and came out with probably more money than a lot of my friends. But, I didn't know how to handle it. I was only 17 when I started college, and I just wanted to go out for dinner and go shopping with my friends. So yeah, that just brings me to, say that, we all love to spend money when we're young, and we don't know the true value of money. So I look back now and I think like how much money I could have saved. So I just want to ask both yourselves, what tips would you give to your younger self in regards to budgeting and handling money? I know we all are a bit loose with our money when we're younger, but if you could give yourself some tips, what would you give yourself?
For me, I'm actually the opposite. I hate spending money.
Okay.
And for me, I guess if we're looking at what I would have told my younger self, it would have been more to not relate money with either self-confidence or just happiness in general. That was something where, as someone, like, I was young, my parents didn't have a lot of money, and I worked and I saved everything. I hated spending money because I wanted to, essentially, in my mind, there was a lot of fear around not having money or growing old without money. And so I was all about the love of money, but for, just to avoid fear or use. And so that I think I came from the opposite of what a lot of people have.
Yeah.
But I think the point is still relevant for whoever it is. I think in our society, we attach money with happiness or status, which once you have the money or the status, then all of a sudden you learn real quick that it really doesn't do much for you. and it just generally, it just makes everything bigger. So if you're happy and you have money, then you can do a lot more to bring that happiness to you. However, if you're upset or scared, or those things follow, and money just magnifies that, in my opinion.
Well, I had a different viewpoint. My dad was an accountant my entire life, and we always budgeting, and we were taught how to budget. So when I came to Canada, I was 18 years old. I bought my first home at 21, and I was so determined that I had to pay it off in 5 years, which I did. And so my entire life, I'm so, I guess it's part of life. We're always budgeting. We're always putting money aside for rainy days. And one of the things I teach my clients is to find a financial advisor. They're the best people to help you budget and save for those rainy days, especially having these beautiful insurance products for your grandchildren when they get older and they have some cash surrender value coming up to pay for their education and things that we don't think about. And they're experts in advising us on what to do.
Oh my God, Patricia, I was just gobsmacked by, buying your first house and paying it off in 5 years. That's
Yes, I did.
amazing. Yeah, that's amazing. Oh my God, my reaction here, if only you could see it. That's amazing. Geez. Well, I should have probably took some of both of you guys' tips when I was younger. I definitely worked a lot, but I just was like too interested in shopping, I suppose. But yeah, no, that's really interesting. Yeah, I just want to say a huge thank you to Richard for coming on the show today.
You bet.
And also Patricia as well, as always.
Thank you.
Okay, great. Thanks so much, guys.
Thanks for listening, and we hope you enjoyed episode 3 of Bread and Honey. If there's any topics that you'd like to see covered on our next episode, don't forget to connect with us now on Facebook, Twitter and Instagram. You can find us by simply searching Marble Financial or using our handle @MyMarbleLife. If you enjoyed today's episode and are looking forward to our next one, don't forget you can visit us now on our website at mymarble.ca/breadandhoney. Otherwise, you can also follow us on Spotify and Apple Podcasts. This way, you can keep up with our next episode. And don't forget, if you're still searching for ways to improve your current financial situation, My Marble can help you. Visit our website now at mymarble.ca to sign up today. Thanks for listening.